Happy New Year and welcome to Echo45 Advisors Market and Economic Update. In this video, we'll cover 5 key lessons and insights from 2023 that could continue to drive markets in 2024. First, this chart shows just how strong a year 2023 was for both stocks and bonds. With reinvested dividends, the S&P 500 gained 26%, while the Nasdaq was up nearly 45%. The S&P 500 is now only 0.6% away from its previous all-time high, exactly 2 years ago. The U.S. aggregate index of bonds gained 5.7% after falling into a bear market the year before. While bonds have not made up for all of their prior losses, last year's performance shows that bonds still play an important role in diversifying portfolios. International stocks, small caps, and a variety of sectors performed well too. Only commodities struggled last year as oil and other commodities fell, but this is after 2 extremely strong years when they were some of the best performing asset classes. Second, this chart zooms into the bond market performance we saw in the prior chart. The red dots show how low the bond market performance fell each year before rebounding. Last year, bonds were down 7% during the banking crisis, but fully reversed course, ending the year on a strong positive note. It's easy to see from this chart that bonds tend to be positive, which is why they help balance the stock market volatility. However, investors should expect the occasional bad year, depending upon interest rates and inflation. Perhaps one of the biggest drivers of markets and the economy over the past few years has been inflation. This third chart shows the impact that inflation has had on Fed policy, specifically that it drove one of the fastest rate hike cycles in history. One of the reasons that markets performed as well as they did in 2023 is that inflation has improved dramatically. You can see on the right-hand side of the chart that the Fed expects that it could begin to cut rates in 2024 by 75 basis points, or 0.75 percentage point. Market-based expectations are anticipating double this number of cuts. If this happens, falling rates could be a tailwind that could support markets and risk assets, representing a reversal of the bear market trends from 2 years ago. Fourth, this chart shows just how strong the economy has been. In the third quarter of 2023, for instance, GDP grew by 4.9% on a quarter-over-quarter annualized basis. This was driven by consumer spending and a rebound in business investment as interest rates stabilized. This means that the recession that was widely anticipated in early 2023 never occurred. Another reason the markets performed as well as they did. However, many expect that the economy will slow from its recent pace, so investors should keep their expectations in check. Finally, it's important for investors not to become complacent after a great year for the markets. Every year experiences market pullbacks that are driven by unexpected events. Last year, these included a banking crisis, rapid Fed rate hikes, dysfunction in Washington, escalating war in the Middle East, cracks in China's economy, and more. In the coming year, investors will focus on possible Fed rate cuts, a presidential election, and more. Thus, the lesson of this past year is that investors should continue to stay invested and diversified. This is the best way to achieve long-term goals. We hope you've had a wonderful start to your 2024. If you would like to discuss any of these topics in more detail, please don't hesitate to reach out. We look forward to speaking with you soon.